Welcome back. This is time for On the Radar, where we ask an investing professional what they're looking at in today's markets. We're back with our featured guest of the morning, Bill Harris of Avenue Investment Management, to talk about how he and his colleagues are investing on behalf of their clients in these markets. And he will talk about two stocks that he and his colleague like at this particular juncture. Let's talk about the macro environment. What do you think of this big stock rally that we've had certainly in the U.S. markets, if not the Canadian market?
Yeah, that's the right way to frame it. So to try to put a big wrapper around this thing, starting with interest rates, and I think it's very interesting this time of the year where we are going to have 3 to 4 Fed cuts, and that that sort of language and trend started happening a few months ago, and then that all propels that the stocks, sort of more expensive stocks and growth stocks. It just propels them. But if we're sitting here today saying unemployment's low, we still have growth, what is the reason why you are cutting interest rates? And the answer is you don't really need to. It's just going to fuel, just further speculation. So I think there's actually a very good argument that you don't need to have interest rates cut. And then how would that roll through the stock market? So, and there's one other issue too, which seems to come up, this consensus idea that we're going to cut interest rates through the summer. The central bank tries not to influence politics, and so when you're 6 months out from an election, you probably shouldn't be messing around dramatically with interest rates. So at least that was a framework. So if interest rates at the short end stay higher longer, does that take some of the shine off of the growth stocks? All the money's gone into the growth stocks. We've had this incredible run. Does that pause? It looks like it probably should pause. So in other words, certainly not doing anything else in that area, and then going back to traditional, more stable businesses and yield, and there's a lot of the businesses we like. Oh, these things actually are still sitting there with high dividends, and as long as your business is doing relatively well, we can go back and look at those things again. So it's just bringing up the point: what have we done recently? So those two companies mentioned, Definity and Insurance. Insurance is actually able to push through. If you've noticed how much you're paying for insurance these days, the pricing just keeps being pushed through from an inflationary point of view. And the stock has had like a little pop here. So sort of telling us what direction these businesses want to go. And then even something like Gibson, which I bring up as an example in the energy industry, what's a really boring business that can't even get caught up on the commodity cycle. But here we have, it's a tank storage type business with a high dividend. It just sort of, bumps along. You make your money, but they're doing very well at keeping a simple business very simple. And so we find those kind of things. This is where we can get capture that dividend, capture that yield, have the stock go up a bit, and lock in that rate of return.
Gibson's not a producer. It is, as you might expect for a dividend payer, a operator of facilities and infrastructure like injection stations, terminals, pipelines, and tank storage as well. I wonder if we can run a graph control room of ZDF in Toronto. ZDF in Toronto. It's a BMO dividend fund. It has rallied since the fall. One of the big questions for investors is, will the Canadian dividend stocks rally as rates come down? We've got about 30 seconds for you to tackle that one.
It's so tricky because all these ones, because I follow a few of those indexes just to see the way they're built. Canada is just the worst because you've got banks, energy companies, and just how they're actually constructed. That's really tricky. It should, but you just said the thing, as interest rates come down, and still asking the question, why are interest rates coming down now? But the stocks are actually quite inexpensive still, and on a yield basis, and if you want to capture that yield in the stock market, we can see why they actually could do well.